unfactored, bullish, at the margin physical gold driver, coiling gold for a very large rally.
Well, historical times indeed, Andrew. Now, on our last episode, you ran through four main drivers to drive the gold price higher. Can you update us on these four drivers?
Yeah, absolutely, Shane. And while the Indian mine that we've just been outlined as another unfactored, bullish, at the margin physical gold driver, coiling gold for a very large rally. As you say, in our last episode, we went over the four largest central bank and sovereign gold buying drivers. Out of the four, which included central bank purchasing repatriations, ballooning global debt, cracks in the US economic drivers, and the hegemony saving increase in the gold to foreign debts ratio rebalancing. Our first tier liquidity providers, though, continue to report the biggest short-term influence to raise the gold price was really item one on our list, which was central bank buying, repatriations, plain vanilla gold sovereign physical gold buying drives the unleveraged physical price higher, draining fractionally held bullion, underpinning this 100-to-1 paper to physical COMEX-centric driven action. I think this is the other part, and we're seeing evidence of this, but we're also seeing this under the table. Repatriations move the ability to double count leased out bullion inside the CME LBMA alliance. And we're evidencing both some openly reported, but the bulk, such as Russia, China, BRICS currency commoditization ramp up, is currently off the radar altogether. So really, to sum that up, having seen how quickly money was weaponized against Russia, China is readying for the inevitable widening of these measures and are ramping up current measures to secure monetary sovereignty alongside Russia by formalizing the BRICS currency basket. Now, Russian and Chinese markets, we're looking closer at these Russian and Chinese market, and based on ongoing discussion with a range of very well liquidity providers exposed to them, we're still assessing the likely weighting of the commodities inside this newly determined BRICS basket of currencies. Now, the accelerated deployment of this currency basket is really grossly underestimated. And, gold and silver will be revalued at a faster pace than the ability to unwind the billions of dollars of bearish derivative bets against a higher gold price. And at the margin, threatening the anchor for close to 1 quadrillion of derivatives and the collapse of the largest ETF, which is GLD. And we know that's not Basel III compliant. So very short term, looking at the wholesale to physical market, we continue to evidence steady, safe haven physical demand from India and Asia, which has up to now become a sell pivot for specs at every pit open. Every pit open, there's been a sell, another sell. We've seen another sell today, right there on the chart, bang. Every single time, regardless of the strong physical buying in Asia. But as evidenced at the end of quarters, as this end of quarter selling has progressed, with specs selling open interest running really thin, the house has been much quicker to take the long side, overrunning the automated pit sellers mindlessly correlated to a rising dollar index and bond yields. Now, the BRICS currency basket is unstoppable. And while the official narrative is notably absent, at the margin, populating this basket with real physical gold and silver will undoubtedly force a price reset. Now, our first tier liquidity providers are positioning for this. However, officials are as wrong-footed as when they tried, as I say, to turn the ruble into rubble. This is a major sort of inflection point. So the disconnect between the US-centric, officially psyop bearish paper gold sentiment into opposing strong, unleveraged central bank and sovereign physical demand is compressing underpriced, tight for supply gold and silver for a gap close upside move. And this is evident by the naked short undeliverable synthetic spec positioning that despite this full-on psyoped momentum into the end of this chart-painted quarter, has begun to run out of available open interest as offsetting actionable backwardations limit the ability to strike fresh market lows. Yes, they keep trying, and they've tried it again today, but there is the insiders are forced to come and cover cover themselves off from the resulting delivery obligations. You can see that through the backwardations. Please, I'm just trying to draw attention to this. And this open interest structure is proportionately akin to when the spec short positioning into the Brown's bottom that we just talked about, where Eddie George made this statement. Gold was at $265 then. Obviously, the circumstances are somewhat different, but in fact, these are much more bullish circumstances. The physical market underpinning the LBMA CME paper market credit book is rapidly migrated into the Sino-Russia bullion trading alliance. Regardless of sanctions, every single oil or physical gold trader we deal with has continued to stealthily transact with Russia, which most recently forced the Swiss refiners to admit they'd done some continued activity with the state-owned banks. But as we've just assessed, this likely now is shut down. So at the margin, what that does is create another blowback. It tightens up supply, underpinning the COMEX. So be careful what you ask for. And as we've just ascertained, India has majorly capitalized on the 30% oil for gold and ruble physical discount, driving additional demand for tons more physical gold, much of it smuggled and off the radar. Now, obviously, we've reported this before, and the World Gold Council already estimate many years now that some 30 tons of smuggled gold come into India every month through the borders, leaky borders. Smuggled gold is always off the radar, but there is a new market for it, tightening up global supply. All this fresh demand appearing just as pent up ×2 post-COVID Indian wedding season also sees wholesalers capitalizing on a cheap paper-driven gold price. Let's not forget that with COVID had really eliminated Indian wedding season in the previous year. So it's double what it was. None of this is factored in when attempting to weaponize gold. It is another reason this weaponizing is going to backfire. And as we previously assessed, while these oil for gold energy physical inflows significantly bolster the Russian war chest, the bulk of these large tonnage inflows divert directly to China, which in turn pays for this physical in rubles. And behind the wall of COMEX-centric paper market smokescreen, both China and Russia are aggressively building gold reserves to back the BRICS currency basket. That's the summation of it. Weaponized Western sanctions related to Russia continue to backfire against the West. And also, as we've just discussed, China is readying against similar sanctions coming into the crosshairs related to an inevitable red line being crossed by the US over Taiwan. Look at what they're doing right now. This is really scary stuff. Now, the long game, though, it's not a brainer. It's just a no-brainer. Anyone with a time horizon longer than a daily range is building gold and silver positions and taking advantage of extremely attractive current dilutive prices. That's what the Indians are doing. That's what the central banks are doing. Sovereigns are doing. Insiders are doing. Very short term, the casino insiders are positioning to keep this 95% win ratio intact ahead of the inevitable industry-wide cash settlement. The only question I have is how much physical do you own?